Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 140, and in this episode we are reviewing the performance of the global markets during the 52nd week of 2024, and that is from Monday the 23rd to Friday the 27th of December. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off by looking at the World Bank's forecast for China's economic growth in 2024 and 2025. On Thursday, the World Bank raised its forecast for China's economic growth in 2024 and 2025, but warned that subdued household and business confidence, along with headwinds in the property sector, will continue to weigh down the economy in 2025. The world's second largest economy has struggled in 2024, mainly due to a property crisis and tepid domestic demand. An expected hike in U.S. tariffs on Chinese goods when Donald Trump takes office in January may also drag down economic growth. According to the World Bank's country director for China, addressing the challenges in the property sector, strengthening social safety nets, and improving local government finances will be essential to unlocking a sustainable economic recovery. On Wall Street this past week, stocks declined across the board on Friday, but the three major indices still managed to post a positive holiday week. A pickup in Treasury yields during the week may have pressured equities as the blue-chip Dow Jones Industrial Average shed 333 points on Friday, but still managed a weekly gain of 0.4% to break a three-week losing streak and eventually settled at 42,992. Meanwhile, the S&P 500 fell about 1.1% on Friday, but advanced by 0.7% during the week before coming to a close at 5,970. And last but not least, the Nasdaq Composite slid by almost 1.5% on Friday as Tesla dropped about 5%, whilst Nvidia fell by 2%. Nevertheless, the Nasdaq slightly outperformed with a weekly gain of about 0.8% before closing the week at 19,722. In the U.S. government bond market, the yield on the benchmark 10-year Treasury bond rose on Friday and was hovering around a 7-month peak as it hit a high of 4.64% in the previous session, which was its highest level since May. The yield on the 10-year Treasury rose more than 4 basis points on Friday to settle at 4.62%, whilst the yield on the policy-sensitive 2-year Treasury note was fractionally lower at 4.31%. The yield on the 10-year government bond has risen more than 40 basis points in December as traders anticipate a more hawkish Federal Reserve in 2025. The Federal Reserve's next policy meeting is scheduled to take place at the end of January 2025, and the consensus expectation is that the Fed will keep its policy rate on hold for the time being. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, despite low trading volumes during this holiday week, the price of crude oil rose more than 1% on Friday and recorded a weekly gain, lifted up mainly by a larger than expected drawdown from U.S. crude oil inventories during the past week. Data from the U.S. Energy Information Administration showed that U.S. crude oil inventories fell by 4.2 million barrels in the week ended the 20th of December as the holiday season boosted fuel demand. On a weekly basis, both benchmarks gained about 1.4% as the price of the global benchmark, Brent crude, settled at $74.17 per barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this was pegged at $70.60 per barrel. In the precious metals market, the price of gold slipped on Friday as elevated treasury yields diminished the appeal for this non-yielding asset, with markets focused on the return of Donald Trump to the White House and the potential impact of his inflationary policies on the Fed's outlook for 2025. The dollar index was headed for a fourth straight week of gains as the yield on the 10-year Treasury was trading at its highest level since May, and both these factors combined to reduce the appeal for gold. So far this year, gold has surged about 28% and hit a record high of $2,790 and now was on the 31st of October. The rally in gold was fueled by a series of rate cuts by the Federal Reserve and heightened global tensions. Despite the Fed projecting fewer rate cuts in 2025, most analysts remain bullish on gold, even as it dipped by 0.7% to close the week at $2,615 per ounce. In the cryptocurrency market, analysts are now predicting that President-elect Donald Trump will not approve a strategic Bitcoin reserve within the first 100 days of his administration. A recent poll shows only a 27% chance that the Bitcoin reserve will be approved, and this is compared to a 60% probability immediately after Trump was elected in November. Proponents of the Bitcoin strategic reserve argue that it makes financial sense because of the demand and supply dynamics. Data shows that Bitcoin demand is rising, with the spot exchange traded funds having over $128 billion in assets under management. Proponents also point to the success of MicroStrategy, which has the largest Bitcoin holdings and which in turn has propelled its valuation to over $80 billion. Some analysts also predict that the United States could ultimately use its Bitcoin holdings to pay off some of its debt, which currently stands at over $36 trillion. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling was flat versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the dollar was quoted at 129.30 compared to 129.29 that was recorded the previous week. Meanwhile, the sterling pound was priced at 161.92 and the euro was valued at 134.32. And on the regional front, one Kenyan shilling was changing hands for 28.37 Ugandan shillings and 18.56 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.64. The dollar-shilling exchange rate appears to be reverting back to its previous static rate of 129.20, where it was for about 2 months. This price action, where the dollar-shilling is trading within a very narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a preferred rate for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should therefore stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $191 million for a total of $9.2 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the interbank market, during the past week, the liquidity situation in the interbank market was sufficient and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined by 14 basis points to 11.09%, down from 11.23% the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 33.7 billion shillings, down from 35.5 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 44 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Tuesday, the 24th of December, and the central bank received bids totaling 4.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 20%, and the results of the auction were as follows. The 91-day rate dipped by 6 basis points to average out at 9.89%, whilst the 182-day rate was flat at 10.02%, and meanwhile, the 364-day rate declined by 12 basis points to settle at 11.40%. And just as a reminder, in the primary bond market, the Central Bank of Kenya has published its prospectus for the January 2025 bond issue and is looking to raise a total of 30 billion shillings for the stated purpose of budgetary support. In this regard, the central bank is inviting bids for the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is FXD1/2018/15 with 8.3 years left to maturity and a coupon rate at 12.65%. The second bond is FXD1/2022/25 with 22.8 years left to maturity and a coupon rate at 14.18%. Please note that both bonds are now open for sale until Wednesday, the 15th of January 2025. In the international bond market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 13-year 2021 Eurobond increasing the most by about 10 basis points as it rose from 9.9% recorded the previous week to 10% flat. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 3.9%, whilst the NSE 25 gained by 1.7%, and the NASI and the NSE 10 both ticked up by just 0.6%. This takes the year-to-date performance to gains of 40.3% for the NSE 25, 40.1% for the NSE 10, 33.1% for the NASI, and 31.4% for the NSE 20. The market's performance was mainly driven by gains recorded by large-cap stocks such as DTB Bank, British American Tobacco, and Stanbic Bank, which increased by 7.9%, 6.1%, and 3.5% respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as Safaricom, which declined by 2.8%. On Kenya's national debt, according to the latest data obtained from the Central Bank of Kenya, the country's national debt as at September 2024 stood at 10.79 trillion shillings, and this was divided between domestic debt, which stood at 5.6 trillion shillings, and foreign external debt that is valued at $40.16 billion, which is equivalent to 5.18 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at above 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we're looking at Safaricom's plan to introduce US dollar transactions on M-Pesa. According to a post on X by Soko Analyst, Safaricom plans to introduce US dollar transactions on M-Pesa. If indeed this is true, it could be a game changer for the domestic foreign exchange market, with the potential to transform how Kenyans access and manage foreign currency. According to the article, the introduction of dollar transactions will offer M-Pesa users the following features and benefits. The first is a dual currency convenience, where M-Pesa users will be able to hold their funds in both Kenya shillings and US dollars. The second benefit is real-time currency conversions, where M-Pesa users using real-time exchange rates will be able to convert their funds between Kenya shillings and US dollars without needing to visit a bank or a forex bureau. This feature will especially be useful for those involved in international trade or anyone traveling abroad. The third is increased transaction limits, given that the initial indication is that M-Pesa users will be able to access a daily limit of $4,000, which is equivalent to about 520,000 shillings, and this provides significant flexibility and is ideal especially for business owners who tend to handle larger payment transactions. The fourth is empowering global trade. This benefit opens up global opportunities for Kenyan entrepreneurs by making international payments easier, faster, and more secure. The fifth benefit is boosting financial inclusion. By integrating dollar transactions into M-Pesa, Safaricom will turn its payment platform into a powerful tool that facilitates both domestic and international transactions, making life much easier for millions of Kenyans. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com, Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, what you're not changing, you are choosing. Think about it. Thank you, and God bless.